Hello, and welcome to the 2023 Market Outlook. My name is Matt Hekman. I'm a portfolio manager here at Waterfront Asset Management. And as we move into the middle part of the second quarter, we wanted to give a brief update on how we're thinking about the performance of markets year to date and the outlook for the rest of this year. So with that, we'll move to the next slide, which just gives a broad overview of consensus outlook for growth, inflation, unemployment rate, industrial production, and then the treasury market, in particular the yield curve. And at a high level, what you'll see at these, if you spend time looking at these numbers, is growth is expected to slow throughout 2023. Here in the US, it's actually expected to slow a little further next year. Inflation is expected to come down, though remain elevated. As a reminder, the Fed's target is 2% inflation rate. Unemployment is expected to pick up as, in response to slowing growth, companies are expected to lay off workers. And as we discussed a couple of months ago, the industrial and manufacturing side of our economy and globally has been in contraction for some time now and is expected to worsen throughout this year before modestly recovering the next year. As a result of elevated inflation, the Fed is expected to continue raising interest rates, including one more time here in the month of May. The upper bound is expected to peak at 5.25% based on this consensus outlook, which is a Bloomberg News survey that was conducted in April, and then stay at a relatively elevated level throughout the rest of this year. And as we've discussed, and you're probably well aware, yield curves are inverted. So what is it that's causing forecasters to be cautious? As we move through the next slides, I'll give you a picture of some of the indicators that are causing people to be relatively cautious about the outlook. The first I just discussed, yield curves broadly are inverted, whether you're looking at a 2-year to 10-year treasury note or a 3-month treasury bill to the 10-year. The yield curve it continues to indicate that markets are anticipating lower rates in the future in response to much slower growth. In fact, the number of yield curves that are inverted today, based on this chart from Ned Davis Research, would suggest that an economic recession is highly likely in our future. That's one. A second caution light is on the next page, which is the Conference Board leading economic indicator, which has continued to contract. It's been in contraction for several quarters now and has declined to a level that, again, historically has been indicative of a recession in the near future. A third caution on the next slide is lending standards. We've discussed this in previous calls as well, but the Senior Loan Officer Survey, which is conducted by the Federal Reserve, continues to get feedback from senior loan officers and domestic banks here in the US that suggests that they are tightening lending standards. This report is updated through October. It actually, the most recent data point we received during the first quarter of this year, and it showed a further tightening. As lending standards tighten, historically that has caused a significant slowdown in growth and is another indicator that is causing forecasters to be cautious. I would just say as a side note, given the disruption that's happening in regional banks here in the US, I would expect that the tightening of lending standards will only further increase over the next couple of months. And I think the next survey is going to be indicate another tightening of lending standards again in the second quarter. The one economic statistic that historically has moved roughly in line with, so as less of a leading indicator, is more of a coincident indicator with economic contractions, is employment. And as was mentioned at the beginning, employment has held in relatively well up until this point. There are increasingly in headlines stories of companies laying off workers And I would expect that this data series would start to turn in a more troublesome direction here in the near future. But up until this point, employment has been stable, and that's important because 2/3 of domestic GDP is driven by consumer spending. And when consumers have jobs and wages are rising like they are today, that's a meaningful backstop that can prevent some of the worst case economic outcomes from ever coming to happen. And that sort of fits with the next slide. So while there are a number of macroeconomic caution lights, there is a significant backstop that continues to hold off some of the more negative economic outcomes from coming to the forefront, or at least impacting us right now. The most significant of which, in addition to employment, is the fact that households are still sitting on a fair amount of checkable deposits. So this is a survey that was put together by BCA Research, Bank Credit Analyst Research, based on the quarterly statements that the large banks published after their first quarter earnings, and based on commentary from other financial intermediaries. And it shows that as a result of the COVID pandemic, consumers built up a fair amount of savings. It was a combination of the government sending money directly to consumers, as well as consumers being unable to spend in entertainment, as an example, travel. And there were a fair number of shortages. So people that wanted to buy a new car or were looking to move into a new house weren't able to get out and shop for those items, or they were unavailable in stores. And so that created an environment where savings, consumer savings, increased dramatically. And somewhat surprisingly, the banks are still indicating that the normalization of consumer balance sheets is still underway. In other words, consumers haven't spent down this significant amount of savings that they built up. I would say if you stratify this chart by income demographic, the lower income part of the distribution is largely through the savings that were built up based on what we're hearing from the banks. And that portion of the population is definitely struggling with the inflation that's happened in core goods and services that's really impacting their livelihoods. A lot of these savings are in the middle and higher income cohorts. And so as that group over the course of the next, I would expect 12 months, starts to pull back on spending, I would expect that number to normalize closer to more normal relationship relative to that trend line that BCA established for us. But that is a significant protection, or I call it a economic storm surge wall against these very forceful negative trends and indicators that are helping to keep the economy from tipping into recession, or at least it has not tipped into recession as of yet. So in the face of all of these caution lights, and with some of these tailwinds, equity markets have performed relatively well. You'll see that on the next slide. Within that, I would say that on the left-hand side of that chart, the performance has been relatively narrow. Larger cap growth year stocks have been where the market has migrated toward. Basically, these are companies that investors have a greater degree of familiarity and confidence in their ability to continue to perform in the face of a lot of headwinds. At a sector basis, commercial services, technology, and consumer discretionary are the only sectors that are up on a year-to-date basis and are driving the total market up in the mid-single-digit-ish range on a year-to-date basis, whereas you see a number of sectors that are really struggling. So while the S&P 500 has a relatively decent positive return year-to-date, that return has been driven by a relatively small cohort of stocks within the index as a whole. On the fixed income side, You'll see in this chart, fixed income has underperformed equity on a year-to-date basis, but still has relatively healthy year-to-date positive returns in the low to mid-single digit range. And on the bottom of that chart are two graphs that depict credit spreads. The one on the far left is investment grade rated debt, and the one on the far right is high yield spreads. And in both cases, while there has been some widening from the tights about a year and a half ago, the spreads continue to be relatively well contained, particularly given all of the concerns over the outlook. And I think a large driver of that is the health, generally speaking, of corporate balance sheets and relatively low interest rates that are locked in for a lot of these companies with fixed rate loans that will reset over the next 5, and 10, and 15 years, but will stay in place for the intermediate term future, which gives investors, I think, confidence that even in the face of a economic contraction that likely lasts, on average 18 to 24 months, these companies will be able to weather that downturn without a significant credit crunch. That remains to be seen whether or not that proves true, but I think that's what markets are anticipating. So as we move to the next slide, we look back on these charts and we use these leading indicators because in the past they've been helpful in helping us anticipate what's coming around the corner. But I think the quote from Heraclitus is a good one. Things are never the same, or rarely are they ever the same. History often rhymes, but it isn't often, or very rarely is it identically the same. Heraclitus said, "No man ever steps in the same river twice, where it's not the same river and he's not the same man." And so, while we pay a lot of attention to these leading indicators that historically have been helpful in helping us to prepare for what's coming down the pike from an economic growth or contraction standpoint, we're cognizant of the fact that every cycle is different. And from my perspective and thinking about managing the waterfront balanced and waterfront equity strategies here, my outlook for growth has continued to deteriorate. However, my focus, my true north, is the same and has not changed and won't change. My compass is focused on quality, profitable companies. And it's during these time periods of difficulty and uncertainty that those kind of companies really shine. And I expect that to prove true again this cycle. And assuming the economic outlook deteriorates further from here, which is my base case, these companies, I believe, will not only be able to survive, but they'll be able to thrive on the other side when recovery happens. And peers that they compete against who aren't as well positioned likely face even more difficult conditions in their business and won't be able to invest in research and development, won't be able to invest in wages and getting the most qualified, most competent employees, won't be able to invest in marketing, etc., to prepare themselves for the recovery that we all know will be on the other side of this. And so these companies, the high quality, profitable cohort of companies that I invest in, my belief and my experience in the past has been that when recovery comes, they perform even more strongly and are positioned even better for the recovery that inevitably will come. And so, as I say at the close of many of my quarterly newsletters, and I'll repeat here again, this approach has served investors well over time, and my confidence in it has not waned. So with that, thank you for your attention. I hope you have a great day, and hope to see you at one of the Waterfront events coming up over the next month or so. Thanks for your time.